Welcome back to Alpha Recap, your post-market rundown from stockalpha.ai. Markets closed, and we have a lot to unpack from the day. From Oracle's AI moment to a big battery beat and some regional risk warnings. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Big day. So, what really stands out here is how a few narrative headlines, an eye-popping partnership, a supplier beat, and a regional hot streak all collided in one session.
Right. The top development going into earnings season was Oracle's upcoming report and whether the much-discussed tie-up with OpenAI actually starts showing up as recurring cloud revenue. People had been talking about a reported $300 billion arrangement, and that number turned into expectations.
Hold on, say that again? $300 billion?
Yeah, $300 billion. That figure reset the bar for what Oracle's AI push could mean. But I mean, when you step back and look at this, headlines like that don't automatically equal cash flows.
Exactly. The market closed reacting to the question, will Oracle convert that strategic partnership into measurable, recurring cloud revenue? Analysts were looking for things like segment-level cloud revenue, any AI-specific contract disclosures, and language around annual recurring revenue or total contract value, ARR and TCV, to see if there's durable monetization.
And that's the heart of it. You can structure an AI deal in lots of ways. It could front-load capital commitments, give discounted infrastructure to a partner, or be backloaded so revenue shows up later as services roll out. So investors really wanted hard metrics, not just PR.
Right. And the other thing is market skepticism. Some strategists think this is Oracle's chance to reclaim cloud relevance. Others warned not to conflate the headline $300 billion with guaranteed future revenue. Amazon, Google, and Microsoft still dominate enterprise cloud and hosting workloads.
And investors were debating timing too. Even if the partnership is real, recognition and contract structure determine how quickly that becomes recurring revenue. So a blowout headline could still leave investors waiting for the next few quarters.
Switching gears, the day's most concrete beat came from CATL, the battery maker. They reported fourth quarter net income of about $3.3 billion and sales of about $20.3 billion. The stock finished the day up about 9%.
Big numbers. And that wasn't just a corporate win. It had read-throughs for automakers, especially Tesla. If battery supply constraints look less severe, that eases a key execution risk for EV growth investors.
I mean, when you step back and look at this, optimism makes sense. Greater scale at a major supplier can mean smoother production and potentially lower costs. But skeptics rightly warned about cyclicality in demand, commodity pressures for lithium and nickel, and margin compression if pricing shifts as capacity ramps.
Yeah, that tracks. So for investors, CATL's beat reduced near-term worries, but you still want to watch guidance on margins and raw material commentary.
Short reaction.
Big move.
Not what anyone expected.
Another notable story from the day. Bank of America flagged recent moves in South Korean stocks as a textbook bubble. That got the attention of risk managers and allocators.
Right. The debate here is classic momentum versus fundamentals. Some investors argued recent gains were sector rotation or technical momentum, not a systemic bubble. Others, notably B of A, urged caution and suggested trimming exposure or reassessing position sizing.
That's why risk teams were watching volume spikes, margin financing indicators, and dispersion across large-cap tech versus more cyclical names. If momentum is driving price action, liquidity and stop-loss planning become more important.
Honestly, I was a bit surprised by this one. Korea had a stretch of really strong flows, but when analysts call something a textbook bubble, you have to at least run your scenario tests.
Totally. Now, in the income corner, a new ETF launched, Amplify's Municipal CEF High Income ETF, ticker YYYM, which packages exposure to roughly 30 municipal closed-end funds into a single ETF wrapper. For taxable, yield-hungry investors, this is convenient. federally tax-advantaged monthly income in an ETF.
But convenience has trade-offs. CEFs often use leverage at the fund level, have distribution and discount to net asset value dynamics, and liquidity can dry up in stress. So the ETF simplifies access, but you still need to evaluate the underlying CEF leverage and where distributions really come from.
Right. Match the product to the purpose. If you're a taxable income investor, YYYM can be interesting, but do the homework on CEF payout sustainability and manager credit selection.
Quick aside, there were a handful of 8K filings today. Co-Diagnostics, KVH Industries, DMY Squared Technology Group, and TransUnion. TransUnion's filing was unusually large, about 25 megabytes, which usually means a lot of exhibits or detailed attachments.
And that matters because Regulation FD disclosures and 8K exhibits can materially reframe a company's narrative. Event-driven investors often get their edge by reading the exhibits before anyone else.
Right. And for activist or event-driven players, accession numbers let you pull filings fast. If there's a presentation or an unusual attachment, that's often where the market moves first.
Let's briefly touch on industrials. Rotork reported non-GAAP earnings per share of 16.9 pence on revenue of about £777 million. For income and industrial-focused portfolios, that's a reminder that earnings cycles are still active, and you need to parse whether margins are durable or a one-off.
The big picture here is contrast. Big strategic narratives that need monetization, Oracle, versus tangible supplier beats, CATL, and then regional sentiment risks in Korea. Investors should be picking their spots.
So let's translate that into what different investors were watching after the close. Growth investors were focused on Oracle's segment-level cloud and AI metrics, plus CATL margins and any confirmation from Tesla on supplier status.
Income and taxable investors were digging into YYYM's prospectus. Average CEF leverage, top holdings, historical discount behavior, and expense structure. Don't buy the headline yield without understanding the source of distributions.
Risk and macro managers were revisiting Korea position sizing and liquidity plans, and event-driven folks were prioritizing the 8K exhibits for those firms we named: TransUnion, Co-Diagnostics, KVH, and DMY Squared.
So, what should investors actually do next? Number 1, separate headlines from monetization signals. For Oracle, trade on measurable revenue traction and contract structures, rather than just the headline number.
Number 2, reprice execution risk where supplier health changes your view. CATL's beat reduced near-term execution risk for EV makers, but watch commodity inputs and margin trends.
Number 3, tighten risk controls where sentiment runs hot. BofA's Korea call is a reminder to review stop-loss frameworks and liquidity if momentum looks detached from fundamentals.
Number 4, read the paperwork. 8K exhibits and ETF prospectuses contain the clauses that matter: leverage, indemnities, off-balance sheet commitments. Don't rely only on summaries.
And number 5, match product to purpose. YYYM can simplify Muni CEF access, but compare it to buying CEFs directly if NAV protection and manager concentration are concerns.
Quick practical watch list we were tracking after the close: Oracle earnings for cloud revenue growth and any explicit AI contract language. CATL follow-ups on margin trends and raw material guidance. Korea equity flows and volatility metrics. YYYM's initial holdings and CEF leverage. Rotork's guidance and payout confirmation, and the 8K exhibits we mentioned. Those accession numbers make them easy to pull up.
Final thoughts before we wrap. The tape today rewarded concrete results over big narratives. CATL delivered numbers and got a strong reaction. Oracle's narrative is powerful, but the market closed asking for proof that the AI tie-up turns into recurring revenue.
Bottom line, pursue selective growth exposure where you can identify clear monetization signals. Use income wrappers carefully after dissecting structure. and tightened position sizing where regional or thematic momentum looks detached from fundamentals.
Yeah, that tracks. Thanks for listening. Short reaction.
Okay, quick takeaways. 1. Oracle's upcoming print was the pivotal story. Watch for measurable cloud revenue. 2. CATL's fourth quarter beat eased EV supply fears, but didn't erase commodity and margin risks. 3. B of A's Korea warning means check your sizing. 4. YYYM simplifies Muni CEF access, but read the prospectus. 5. Always read those 8K exhibits.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
That's our Alpha recap for today. Thanks for closing the markets with us. We'll be back after the next session with more context. Have a good evening.